Right now, over $1 billion in tax refunds are sitting there unclaimed. That's not a made-up number. The IRS confirmed that more than $1 billion in 2021 refunds remains unclaimed because people simply didn't file. And here's the thing that really gets me. Nearly 1 in 3 Americans say just thinking about filing taxes makes them want to cry. For Gen Z workers, that number jumps to 40%. People would rather give up a whole paycheck than deal with their taxes. But why? Why does something that could put thousands of dollars in your pocket cause so much pain? Because nobody ever taught us how to do it. Until now. By the end of this video, you're going to know exactly how to file your taxes, step by step. You'll understand things like calculating your income, claiming your deductions, and avoiding the mistakes that trigger audits. And stay until the end, because I'm going to reveal the credits that most people miss. Credits worth up to $6,728. Let me ask you something. Do you know where your tax money goes? Your dollars pay for things like roads you drive on, schools your kids attend, and hospitals that save lives. Understanding this helps change how you feel about taxes. Research from the American Psychological Association shows that 73% of Americans say money is their #1 cause of stress. And guess what makes money stress worse? Not knowing how the tax system works. Here's the good news. The average tax refund in 2025 is around $3,116. That's 3.5% more than last year. For many families, this is the biggest check they receive all year. So taxes aren't just about giving money to the government. They're about getting your money back. And the better you understand this system, the more money stays in your pocket. Stick with me. I promise this will change how you see taxes forever. Before we do anything else, you need to gather your documents. Think of it like packing for a road trip, gathering ingredients before cooking, or getting your tools before fixing something. You wouldn't start without everything ready, right? First, your W-2 forms. If you work for a company, they must send you a W-2 by the end of January. This paper shows how much you earned and how much tax was already taken from your paychecks. Got side jobs? Maybe you drive for Uber, sell things online, or do freelance work. You'll get 1,099 forms. According to the IRS, you must report all income, even if you don't get a form for it. Also gather any 1099 INT forms from your bank, showing interest you earned. Got investments? You'll need 1099 DIV for dividends and 1099B for stocks you sold. Write these down. We're building your tax toolkit. We're not done with documents yet. If you're a student or paid for college, find your 1098T form. This shows tuition payments and could unlock huge education credits. Homeowners, listen up. Your 1098 form shows mortgage interest you paid. This is very important if you plan to itemize your deductions. I'll explain itemizing later. It could save you thousands. Keep receipts for charitable donations, medical bills, and work expenses if you're self-employed. Things like donation slips from Goodwill, hospital invoices, and receipts from office supplies all count here. One more thing. If the IRS sent you an identity protection PIN, you need this 6-digit number to file. Without it, your return gets rejected. Save yourself the headache. Find these documents now. Okay, let's talk about gross income. And no, it's not called gross because it's disgusting. Gross income means your total money before anything gets taken out. Picture this. You work at a store making $50,000 a year, but your paycheck shows less because taxes come out. That $50,000? That's your gross income. It's the big number before deductions. Gross income includes your wages, tips, bonuses, interest from savings, rental income, even money from selling stuff online. The IRS wants to know about all of it. Why does this matter? because your tax rate depends on your gross income. The federal income tax has 7 different rates, from 10% all the way up to 37%. But don't worry, you don't pay the highest rate on all your money. Let me explain how brackets actually work. This is where most people get confused, and I'm about to make it crystal clear. Tax brackets are like steps on a staircase. Each step has a different rate. Imagine you're single and earned $50,000. You don't pay 22% on all $50,000. Instead, you pay 10% on the first $11,925, then 12% on the next portion, and only pay 22% on the amount above $48,475. See how that works? This is called a progressive tax system. It means the more you earn, the higher percentage you pay, but only on the extra money you make above each threshold. For 2025, single filers get a standard deduction of $15,000, which means that amount is completely tax-free. So if you made $50,000, only $35,000 is actually taxable. Understanding this changes everything. Now we're getting to the good stuff. Deductions are like magic tricks that make part of your income disappear from taxes. You have 2 choices, standard or itemized. The standard deduction is a set amount based on your filing status. For 2025, it's $15,750 for single filers and $31,500 for married couples filing jointly. You get this amount without having to prove anything. Itemized deductions are different. You add up all your mortgage interest payments, charitable donations to churches or organizations, and state taxes you paid. If that total is more than the standard deduction, itemize instead. Research shows that most filers take the standard deduction because it's simpler. But if you own a home or give a lot to charity, run the numbers. Compare your total itemized amount to the standard amount and pick whichever number is bigger. Your filing status is like choosing which line to stand in at the store. Pick the wrong one and you wait longer, or pay more. The IRS says choosing the wrong status is one of the most common mistakes. There are 5 filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. Each one has different tax rates and deduction amounts. Married filing jointly usually gives the best tax breaks, but if you're separated or your spouse has tax problems, filing separately might protect you. This is like keeping your groceries in separate carts so you don't pay for their items. Head of household is a special status for single parents or people supporting family members. You get a higher deduction than single filers. For 2025, that's $22,500 instead of $15,000. That's $7,500 more in tax-free income. Listen carefully here. Each Social Security number on your tax return must appear exactly as printed on your Social Security card. One wrong digit and your return gets rejected. Get your Social Security card out right now. Write down the number, double-check it, then check it again. This is like making sure you dial the right phone number before an important call, typing the correct email address before sending a message, or entering the right password to unlock your phone. This applies to everyone on your return: your spouse, your kids, all dependents. A mismatched name or number creates delays that can stretch for weeks. If you've lost your Social Security card, you can request a new one at ssa.gov. But do this early in tax season, not the week before the deadline. Trust me, you don't want that stress. Now, how are you going to file? You've got options. You can use free online software, hire a professional accountant, or even do it by hand on paper forms. Let's break this down. According to the IRS, the error rate for paper returns is 21%, compared to less than 1% for e-filed returns. That's a massive difference. Electronic filing catches your mistakes before you submit. The IRS offers free filing options. IRS Free File works for people earning under $84,000. IRS Direct File is available in certain states. And if you're over 60 or have a disability, volunteers can help you file for free. Popular paid options include TurboTax, H&R Block, and TaxAct. These programs walk you through questions like, did you have a baby this year? Or did you pay for college? And fill in the right forms automatically. They basically hold your hand through the whole process. Before you start filing, create an account at irs.gov. This is your portal to see what the IRS knows about you, and it shows transcripts, past returns, and payment history. Think of it like checking your credit report before applying for a loan, reviewing your grades before a job interview, or looking at your bank balance before making a big purchase. You want to know where you stand. Having an IRS account lets you see if employers reported your income correctly. Sometimes businesses make mistakes. Finding errors now saves headaches later. The account also shows your identity protection PIN if you have one, and lets you make payments directly. Plus, 9 out of 10 refunds are issued in less than 21 days. And you can track your refund status right from your account. Let's really understand your W-2, because this form has a lot of boxes. Each box tells a different story about your work year. Box 1 shows your taxable wages. Box 2 shows federal income tax already withheld. Box 3 shows Social Security wages, and Box 4 shows Social Security tax paid. Make sure these numbers match what you expected. Box 12 contains special codes, things like retirement contributions you made, code D, health insurance premiums, code DD, and other benefits that affect your taxes differently. Don't ignore these codes. The IRS says missing or inaccurate information is one of the most common filing errors. If something looks wrong on your W-2, contact your employer immediately. They have until mid-February to send corrections. Do you drive for DoorDash? Sell crafts on Etsy? Tutor kids on weekends? The IRS wants to know about every dollar. Self-employment income goes on Schedule C. You report your total income, then subtract your business expenses. Things like gas for your delivery car, shipping supplies for your Etsy shop, or books you bought for tutoring students all count as deductions. Here's the good news. You can deduct home office expenses if you work from home. You can deduct your phone bill if you use it for business. You can deduct your internet costs. But you must keep records. Receipts in a folder, a simple spreadsheet, or even photos on your phone work great. The IRS can ask for proof, and I forgot is not an acceptable answer. Deductions are money subtracted from your income before calculating taxes. Think of deductions as shields, protecting your income from being taxed. There are two types of deductions, above the line and below the line. Above the line deductions reduce your gross income before you choose standard or itemized. These include contributions to retirement accounts, student loan interest you paid, and health insurance premiums if you're self-employed. Below the line deductions come after, through itemizing. These include mortgage interest on your home, state and local taxes up to $10,000, and donations to qualified charities. According to tax professionals, many taxpayers miss deductions simply because they didn't know they qualified. By the end of this video, you'll know exactly which deductions to claim. If deductions are shields, then tax credits are weapons. Credits directly reduce the taxes you owe, dollar for dollar. Here's the difference explained simply. A $1,000 deduction saves you maybe $220 if you're in the 22% bracket. But a $1,000 credit? That saves you exactly $1,000. Credits are way more powerful. According to IRS data, the Earned Income Tax Credit alone can be worth up to $8,046 for families with qualifying children. That's potentially thousands of dollars back in your pocket. Some credits are refundable, meaning you get money back even if you owe zero taxes. Others are non-refundable. They can reduce your bill to zero, but won't give you extra. Understanding this difference is crucial. The Earned Income Tax Credit, or EITC, is one of the most valuable credits for working families, and an estimated $11 billion in EITC goes unclaimed every year. This credit helps low to moderate income workers. For 2021, the EITC was worth as much as $6,728 for taxpayers with qualifying children. Even workers without children can qualify for smaller amounts. You must have earned income to claim EITC. Money from working at a job, running your own business, or even farming counts as earned income. But Social Security, unemployment, and investment returns don't count. Here's something most people don't know. If you didn't claim EITC in past years but qualified, you can file amended returns and get that money. The IRS gives you 3 years to claim missed refunds. If you have kids under 17, the child tax credit is your best friend. According to the IRS, the child tax credit is the #1 area where taxpayers make errors, so let's get it right. The credit is worth up to $2,000 per qualifying child for 2024 returns. Part of this is refundable, meaning you can get money back even if you owe no taxes. To qualify, your child must be under 17, live with you for more than half the year, be related to you, be a U.S. citizen, and you must claim them as a dependent. This includes your sons, daughters, stepchildren, foster children, and younger siblings you support. The credit starts phasing out at $200,000 for single filers and $400,000 for married couples. That's a much higher limit than most credits, which means middle-class families benefit too. Going to school? Paying for your kids' college? The tax code wants to help you. There are 2 major education credits you need to know. The American Opportunity Credit is for the first 4 years of college. It can be worth up to $2,500 per eligible student. Even better, 40% of this credit is refundable. The Lifetime Learning Credit offers up to $2,000 per tax return for tuition and fees. This one covers graduate school, professional degrees, and even classes to improve job skills. You can't claim both credits for the same student in the same year, but you can claim different credits for different students. If one child is in their first year of college and another is in graduate school, you might claim different credits for each. Had major medical bills this year? You might be able to deduct them. Many taxpayers miss this opportunity because they don't realize medical expenses are deductible. Here's the catch. You can only deduct medical expenses that exceed 7.5% of your adjusted gross income. So if you made $50,000, only expenses over $3,750 count toward your deduction. Qualifying expenses include doctor visits and specialist appointments, prescription medications, dental work like braces and root canals, vision care like glasses and contacts, and even travel to medical appointments. This deduction works best for people with major medical events, things like surgery, cancer treatment, or chronic illness care. If you itemize deductions, add up all your medical costs, you might be surprised. Do you give to charity? The tax code rewards your generosity. Cash donations, donated goods, and even mileage driven for charitable purposes can be deducted. Keep records of everything. For cash donations under $250, a bank statement or receipt works. For donations over $250, you need a written acknowledgement from the charity showing the date you gave, the amount you gave, and what, if anything, you received in return. Donated that old couch or bag of clothes? You can deduct their fair market value. The price someone would reasonably pay at a thrift store is usually what you can claim. Keep photos and itemized lists. You must itemize to claim charitable deductions, except for certain tax years when Congress allowed extra deductions. Research shows many people take the standard deduction and miss these savings. Run the numbers both ways. The state and local tax deduction, called SALT, lets you deduct certain state and local taxes you paid. But there's a cap. Currently, you can deduct up to $10,000 in state and local taxes. This includes state income taxes taken from your paycheck, property taxes on your home, and even sales taxes in states that don't have income tax. If you live in a high-tax state like California, New York, or New Jersey, you might hit this $10,000 limit fast. That's frustrating for many homeowners who pay way more in property taxes alone. Some people choose to deduct sales tax instead of income tax. Taxpayers in states without income tax often benefit from the sales tax deduction. The IRS provides tables to estimate your deduction, or you can calculate actual sales tax from receipts. Own a home with a mortgage? You're probably paying thousands in interest every year. And guess what? That interest can be deducted. Your mortgage company sends you Form 1098 showing how much interest you paid. This deduction is one of the biggest reasons homeowners choose to itemize. The deduction applies to interest on mortgages up to $750,000, or $1 million if you bought before December 2017. This covers your primary residence, a vacation home, and even home equity loans used to improve your property. Early in your mortgage, most of your payment goes toward interest, which means bigger deductions. As you pay down your loan, less goes to interest. This is why new homeowners especially benefit from itemizing. If you're self-employed, pay attention. You have special taxes and special deductions that employees don't get. Self-employment tax covers Social Security and Medicare, and it's 15.3% of your net earnings. That's on top of regular income tax. But here's the good news. You can deduct half of that self-employment tax from your income. You must make quarterly estimated tax payments throughout the year. Due dates are April 15th, June 15th, September 15th, and January 15th. Missing these payments means penalties and interest. But you also get amazing deductions. Health insurance premiums, retirement contributions up to $23,500 in a solo 401k, and that home office we talked about. Self-employment is hard, but the tax advantages are real. Want to pay less in taxes today while building wealth for tomorrow? Retirement contributions are your answer. Traditional 401k and IRA contributions are deducted from your income. For 2025, you can contribute up to $23,500 to a 401k, and that entire amount comes off your taxable income. If you're 50 or older, you get catch-up contributions too. That's an extra $7,500 in 401k contributions, for a total of $31,000 in tax-deductible savings. IRAs work similarly with a $7,000 limit, plus $1,000 catch-up if over 50. Think about it this way. If you're in the 22% bracket and contribute $7,000 to a traditional IRA, you save $1,540 in taxes this year while building your retirement. Got a high-deductible health plan? You need a health savings account, or HSA. This is like a triple tax advantage. Contributions are tax-deductible, money grows tax-free, and withdrawals for medical expenses are never taxed. No other account gives you all three benefits. For 2025, you can contribute up to $4,300 as an individual or $8,550 for a family. Plus, there's a $1,000 catch-up for people 55 and older. Here's the real secret. You don't have to spend your HSA this year. Let it grow, invest it, and use it for medical expenses in retirement. Many financial experts consider HSAs the most tax-efficient retirement vehicle available. Now let's talk about what can go wrong. Math errors are one of the biggest mistakes taxpayers make. Even simple addition and subtraction errors create problems. Filing too early is also risky. If you file before receiving all your tax documents, you might miss income and have to file an amended return later. According to the IRS, misspelled names and incorrect Social Security numbers are extremely common errors. Check every name and number against official documents before submitting. Unsigned returns are invalid. If you file paper, both spouses must sign a joint return. Electronic filing eliminates this problem because you digitally sign. This is just one more reason to file electronically. Choosing the wrong filing status is another major error, and it can cost you thousands of dollars. Research shows many Gen Z filers are uncertain about their tax filing abilities because the system is too complicated. Filing status confusion is a big part of that. If you got married this year but filed as single, you missed bigger deductions. If you're divorced but filed jointly, that's illegal. If you support your elderly parent but didn't claim head of household, you lost money. Use the IRS Interactive Tax Assistant at irs.gov to determine your correct status. Simply answer questions about your living situation, marital status, and dependents, and it tells you which status applies to you. Here's a mess nobody wants: two people claiming the same dependent. This automatically triggers problems with the IRS. Only one taxpayer can claim a dependent in a given year. According to the IRS, if a dependent has already been claimed by someone else, your return may be rejected. This often happens with divorced parents fighting over claiming children, adult children who file their own taxes while parents still claim them, or families where multiple people help support elderly relatives. Before filing, communicate with family members. Ask your ex-spouse whose turn it is to claim the kids, tell your adult child you're claiming them, and coordinate with siblings about elderly parents. A simple conversation prevents major headaches. Want your refund fast? Choose direct deposit, but enter the wrong routing or account number and your money goes somewhere else. According to the IRS, incorrect bank account numbers are among the most common mistakes. Double-check. No, triple-check those numbers. Find your routing number on a check or in your banking app. It's the 9-digit number on the bottom left. Your account number is the longer number next to it. If you did make this mistake and your refund goes to the wrong account, the IRS has procedures to help. But it can take months to sort out. Save yourself weeks of stress by verifying those numbers before you submit. When you file matters. The regular deadline is April 15th every year. Miss it, and penalties start immediately. Research shows that 40 to 50 million Americans file their taxes in the final weeks of tax season. Waiting until the last minute makes errors more likely. If you can't file by April 15th, request an extension using Form 4868. This gives you until October 15th to file. But an extension to file is not an extension to pay. You still owe any taxes due by April 15th. If you don't pay, you'll face interest and penalties on the unpaid amount. Estimate what you owe, pay it, then take your time getting your return perfect. I've said it before, and I'll say it again: e-file. The IRS reports that over 90% of all returns are now filed electronically. According to the IRS, electronically filed returns have less than 1% error rate compared to 21% for paper returns. The software catches mistakes before you submit. E-filed returns process faster, too. 9 out of 10 refunds are issued in less than 21 days. Paper returns can take 6 to 8 weeks. Plus, e-filing creates an electronic record. You get confirmation that the IRS received your return. No worrying about lost mail or missing signatures. It's like getting a read receipt for the most important email of the year. Speaking of speed, combining e-file with direct deposit is the fastest way to get your money. Nearly 86.7 million taxpayers received their refunds via direct deposit. That's the majority of refund recipients. Direct deposit eliminates the risk of lost or stolen checks. No waiting by the mailbox, no worrying about theft, no trips to the bank to deposit. The money just appears in your account. You can even split your refund among multiple accounts. Want part in checking and part in savings? Want some to go toward buying savings bonds? You can do all of this through direct deposit. Don't have money for expensive tax software? You don't need it. The IRS offers several free filing options. IRS Free File is available if your adjusted gross income is $84,000 or less. Partner companies offer their software completely free through this program. IRS Direct File lets you file directly with the IRS. No third-party software needed. It's available in many states and expanding every year. VITA, the Volunteer Income Tax Assistance Program, offers free help for people earning under $67,000, people with disabilities, and limited English speakers. And TCE, Tax Counseling for the Elderly, helps seniors for free. These programs have IRS-certified volunteers who can prepare your return. Sometimes, doing taxes yourself isn't the best choice. When should you hire a professional? If 49% of Americans have little to no understanding of how to fill out tax forms, there's no shame in getting help. Complex situations require expert knowledge. Consider hiring a CPA or enrolled agent if you own a business or have complicated self-employment income, you bought or sold property this year, you received an inheritance, or you're facing an IRS audit. Tax professionals cost money up front, but they often save you more than they charge. They know deductions you might miss and can represent you if the IRS has questions. Think of it like hiring a guide for a complicated hike rather than getting lost on your own. Nobody wants an audit. Let's talk about what triggers IRS attention so you can avoid red flags. According to IRS data, audit rates remain low overall, but high-income earners face more scrutiny. Taxpayers earning over $1 million are audited most frequently. Other triggers include taking excessive deductions compared to your income, claiming business losses year after year, having unreported income that shows up on 1099s, and making math errors that don't add up. But here's the truth. Only about 0.4% of returns get audited. If you're honest and accurate, you have almost nothing to worry about. Just keep good records in case questions arise. Not everyone gets a refund. Nearly half of taxpayers who owe money were surprised by their tax bill. If that's you, don't panic. The worst thing you can do is not file. Even if you can't pay, file your return anyway. The penalties for not filing are much higher than penalties for not paying. The IRS offers payment plans. A short-term plan gives you 120 days to pay. A long-term installment agreement lets you pay over up to 72 months. Apply for a payment plan at irs.gov or call the IRS directly. You'll pay interest and some penalties, but manageable monthly payments are better than drowning in debt. It's like setting up a payment plan for a big medical bill rather than ignoring it. Made a mistake on a return you already filed? You can fix it with an amended return using Form 1040-X. According to the IRS, if you made a math error, they usually catch and correct it automatically. You'll get a letter explaining the adjustment. No action needed. But if you forgot income, missed a deduction, or claimed the wrong credits, you need to file the amendment. You have 3 years from the original filing date. Amended returns can't be e-filed for recent years. You must mail them. They take 16 weeks or more to process. Be patient, keep copies of everything you send, and check the status online through your IRS account. Tax identity theft is real. Criminals steal Social Security numbers and file fake returns to steal refunds. Signs you're a victim include receiving an IRS notice about income you didn't earn, finding out someone else filed using your Social Security number, or getting a letter saying you owe taxes for a job you never had. Protect yourself by filing early before criminals can file using your information, using strong passwords on tax software accounts, and never sharing your Social Security number unless absolutely necessary. The IRS offers identity protection PINs to victims, and now anyone can request one. This 6-digit number proves it's really you filing. Without it, no one else can file under your name. Filed your return and waiting for money? You can track it. The IRS Where's My Refund tool shows your status. The tool updates once every 24 hours, usually overnight. Enter your Social Security number, filing status, and exact refund amount to check. You'll see one of 3 statuses: return received, refund approved, or refund sent. Return received means they got it and are processing. Approved means your refund amount is confirmed, and sent means the money is on its way. If you filed electronically, wait at least 24 hours before checking. If you mailed a paper return, wait at least 4 weeks. Checking obsessively won't speed things up, though I understand the temptation. So, when will you actually get your refund? Most electronically filed returns with direct deposit get refunds in less than 21 days, but certain returns take longer. If you claim the Earned Income Tax Credit or Additional Child Tax Credit, the IRS cannot issue those refunds before mid-February by law. Paper returns take 6 to 8 weeks, sometimes longer. In 2024, almost 18 million electronically filed returns were initially rejected, causing delays for resubmission. Want your refund fastest? File electronically, choose direct deposit, and double-check everything before submitting. Simple steps that put money in your pocket weeks sooner. Getting money back is exciting, but what you do with that refund matters for your financial future. According to research, nearly 2/3 of people expecting refunds spend all of it within a month. Money come, money go. Consider better uses. Pay down high-interest credit card debt first. Build an emergency fund with 3 to 6 months of expenses. Contribute to retirement accounts for even more tax benefits. Or invest in yourself through education or skills training. A tax refund is your money that you overpaid throughout the year. Using it thoughtfully turns a windfall into long-term wealth. Think of it as a bonus for your future self. Getting a huge refund? That might actually be bad. It means you gave the government an interest-free loan all year. Adjust your W-4 form with your employer to reduce withholdings. Instead of getting $3,000 back in April, you could have an extra $250 in every paycheck throughout the year. The IRS provides a tax withholding estimator at irs.gov. Answer questions about your income, deductions, and credits, and it tells you exactly how to fill out your W-4. Some people like big refunds. It feels like forced savings. That's okay. Just know you have options. The right choice depends on your discipline with money and what makes you feel most secure. Federal taxes aren't the only taxes you pay. Most states have their own income taxes too. 7 states have no income tax at all. Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming give residents a break. 2 more states, New Hampshire and Tennessee, only tax investment income. If you live in a state with income tax, you'll file a separate state return. Often you can use the same software and it transfers information automatically. State tax rules differ from federal rules. Deductions and credits vary. Some states follow federal rules closely, others are completely different. Check your specific state's requirements at your State Department of Revenue website. If you're self-employed or have income without withholdings, you must pay estimated taxes quarterly. Estimated taxes are due April 15th, June 15th, September 15th, and January 15th of the following year. Miss these dates and you'll face penalties. Use Form 1040ES to calculate and pay estimates. The goal is to pay at least 90% of what you'll owe, or 100% of what you owed last year. Set calendar reminders for each payment date. Keep a separate savings account for estimated taxes, and pay online at irs.gov/payments for the fastest processing. Staying on top of estimates keeps you penalty-free. How long should you keep tax records? The answer depends, but generally, at least 3 years. The IRS typically has 3 years to audit your return, but in some cases, they can go back 6 years, and if fraud is suspected, there's no limit. Keep these records: copies of your filed returns, W-2s and 1099s, receipts for itemized deductions, records of property purchases and sales, and documentation for any claimed credits. Digital storage works great. Scan everything and keep backup copies in the cloud. Physical papers fade and get lost, but a well-organized digital folder lasts forever. Getting married changes your taxes. Sometimes for the better, sometimes not. The marriage bonus happens when one spouse earns much more than the other. Combined, you often pay less than two single filers. The marriage penalty happens when both spouses earn similar high incomes. Combined, you might end up in a higher bracket. Married couples should always calculate taxes both ways, filing jointly versus separately. Usually joint is better, but not always. Run the numbers or ask a tax professional. Divorce complicates taxes. Here's what you need to know. Your filing status on December 31st determines your status for the entire year. If your divorce was finalized December 31st, you're considered single for that whole year. If you pay child support, that's not tax deductible. If you receive child support, you don't have to report it as income. Alimony rules depend on when your divorce was finalized. Make sure your divorce agreement specifies who claims the children as dependents. Often, parents alternate years, but the agreement must be clear. Confusion here leads to IRS problems. Dealing with a loved one's death is hard enough, but there are tax implications to handle. A final tax return must be filed for the deceased person. This covers income from January 1st until the date of death. Surviving spouses can file jointly for the year of death, and for 2 more years after, they may qualify for the qualifying surviving spouse status with its higher deductions. Estates may need their own tax return if they generate income. Things like interest earned on bank accounts, rent from property, or dividends from stocks after the death get reported on estate returns. Consider hiring help for this complex situation. Move to a new state this year? You might owe taxes to both states. Generally, you pay taxes to each state based on how much income you earned while living there. If you lived in California from January to June and earned $30,000, then moved to Texas and earned $30,000, California wants taxes on that first $30,000. Each state has different rules for part-year residents. You'll likely file part-year returns in both states. The good news? States have agreements to prevent double taxation on the same income. You usually get credit for taxes paid to other states. Just make sure to file all required returns. The gig economy is booming. Uber, DoorDash, freelance work, selling online, these all have tax implications. If you earn over $400 in self-employment income, you must file a return. And you'll owe self-employment tax of 15.3% for Social Security and Medicare. Track everything. Miles driven for deliveries, supplies bought for crafts, equipment purchased for freelance work, these are all deductible from your self-employment income. You might receive Form 1099K from payment platforms. Apps like PayPal, Venmo, and Etsy report payments to the IRS. Even if you don't receive a form, the income is still taxable. Report it honestly. Own Bitcoin, Ethereum, NFTs? The IRS wants to know. Cryptocurrency has specific tax rules. Crypto is treated as property, not currency. Selling crypto, trading one crypto for another, even buying things with crypto all create taxable events. Keep records of every transaction. When you bought, what you paid, when you sold, what you received. The difference is your capital gain or loss. The IRS is cracking down on unreported crypto. According to reports, they're using sophisticated tracking tools to find people who don't report. Don't take the risk. Report everything. Investments create taxable income too. Understanding the rules helps you keep more of your gains. Dividends and interest are generally taxed as ordinary income, but qualified dividends and long-term capital gains, assets held over 1 year, get lower rates, 0%, 15%, or 20%. Tax loss harvesting means selling losing investments to offset gains. If you made $5,000 on stock A but lost $3,000 on stock B, you only pay taxes on the net $2,000 gain. Keep investments in the right accounts. Growth stocks that you won't sell for years go well in taxable accounts, lower long-term capital gains rates. High dividend stocks and bonds do better in tax-advantaged retirement accounts where growth isn't taxed annually. Own rental property? Rental income is taxable, but you get lots of deductions. You can deduct mortgage interest on the rental, property taxes, insurance premiums, repairs and maintenance, property management fees, and even depreciation on the building itself. Depreciation is powerful. It lets you deduct part of the building's value each year, even though the property might actually be gaining value. This creates paper losses that offset other income. Rental losses are sometimes limited by passive activity rules. If you earn too much from your regular job, you might not be able to deduct rental losses immediately. They carry forward to future years. This gets complicated. Consider professional help. Running a business opens up a world of tax strategies. Let's cover the basics. Business structure matters. Sole proprietors report on Schedule C. LLCs can choose how they're taxed. S-corps can provide tax savings by splitting income between salary and distributions. The qualified business income deduction lets pass-through business owners deduct up to 20% of their business income. That's a huge tax break. Maximize retirement contributions through your business. A solo 401k lets you contribute as both employer and employee, potentially saving tens of thousands in taxes while building wealth. Here's the shift that changes everything. Stop thinking about taxes once a year. Start thinking about them all year long. Tax planning means making decisions throughout the year that minimize your tax burden. Timing income and deductions, choosing the right accounts, harvesting losses, these strategies work best when planned in advance. Review your situation quarterly. Check your withholdings, estimate your tax bracket, and make adjustments before December 31st when most options disappear. The wealthy don't pay less taxes by accident. They plan strategically within the law. You can do the same thing, starting today. You don't have to figure this out alone. Here are resources to help. IRS.gov has free tools. The Interactive Tax Assistant answers questions. The Tax Withholding Estimator helps with W-4s, and Publication 17 explains tax rules in plain language. IRS Publication 17 is the complete guide to filing individual tax returns. It's hundreds of pages, but covers everything. For questions, the IRS phone line is 1-800-8291-040. Wait times can be long, but representatives can help with specific situations. You can also visit taxpayer assistance centers in person. Tax season brings scammers out in force. 45% of taxpayers who owe money report being targeted by tax relief scams. The IRS will never call demanding immediate payment, threaten arrest, require specific payment methods like gift cards, or ask for credit card numbers over the phone. Real IRS communication starts with letters, not phone calls or emails. If you get a suspicious call, hang up and call the IRS directly at their official number. Report scams to the Treasury Inspector General at 1-800-366-4484. Don't be embarrassed if you almost fell for one. These criminals are sophisticated. Report them so they can't trick someone else. Let's turn everything we've learned into habits. Small actions throughout the year make tax time easy. Create a tax folder, physical or digital. Every time you get a tax document, it goes in the folder. W-2 arrives? Folder. 1099? Folder. Donation receipt? Folder. By tax time, everything's already organized. Set calendar reminders for important dates. January 31st. Watch for W-2s. March, review withholdings. June 15th, second quarter estimates due. December, last chance for deduction strategies. Each year gets easier. The first time you file is the hardest, but once you understand the system, it becomes routine. Like riding a bike, awkward at first, then second nature. Let's recap what you've learned in this full tax course. Gather your documents early. W-2s, 1099s, receipts. Choose the right filing status. Decide between standard and itemized deductions based on which saves you more. Don't miss valuable credits. The EITC for low to moderate income workers, child tax credits for parents, and education credits for students can put thousands back in your pocket. E-File with direct deposit for the fastest, most accurate results. Keep records for at least 3 years. And if you need help, get it. Free options exist. You now know more about taxes than most Americans. Here's your action plan. Today, gather your Social Security card and create an IRS account. This week, collect all your tax documents as they arrive. This month, choose your filing method and start your return. Remember, the average tax refund is over $3,000. That money could be yours, but only if you file. Taxes don't have to be scary. They don't have to be overwhelming. With the knowledge you have now, you can file with confidence. Thank you for watching this entire course. You invested time in yourself today, and that investment will pay off for years to come. Now go file those taxes and get your money.